Welcome to the Dashboard series of short videos in which our intention is for you to maximize the returns of your investment by understanding better all the moving parts of the system. In this video, we're going to talk about option drag and positions. We will be now focusing on the tab that says positions down here. This is a photograph. This is a snapshot of the positions that this account in particular had at the moment that the dashboard was updated. First of all, we're going to explain option drag, and for that purpose, we have already highlighted here a couple of positions that we're going to use to understand the concept of option drag. The total option drag of an account is given by adding up this column that says market value. The option drag is given by the addition of all these figures under the column called market value. These positions, we get them directly from Alkys. When we add up all these figures that we have under the column of market value, in the case of this account in particular, we got an option drag of minus 281,329. When we explain option drag, we tend to say that Alkys does this calculation based on the assumption that all the puts that we have are put to us, are assigned, and then we sell them back to the market directly. If in this account we were assigned all the puts that we have sold and we sold the shares immediately directly to the market, we would be down 281,000. Let's see a couple of positions as an example to see how these numbers are calculated. What Alkys calls market value of the options, and we call option drag. To calculate the option drag of a couple of positions in particular, we are going to use two examples. The first one that I've chosen is this one, Alkys. We sold a 19 put, that's the strike, first thing that we need to do the calculation. We sold 3 contracts, 1, 2, 3. The ticker is Alkys, and the option drag of this position, Alkys is telling us that it's minus 1,207 with 53 cents. Why did I choose this position? To explain option drag, reason behind it is because, as it happens, we also have shares on this stock Alkys. We have 1,200 shares. The price that this stock is trading at the moment in this snapshot is 16.25. I've made this little table so that we can see all the figures and the calculations. Alkys, the strike, we said that it was 19. We sold 3 contracts and the price today is 16.25. Now let's proceed with the calculations. If the puts were assigned, how much we would have to pay? 5,700. Where is this number coming from? Well, if the puts were assigned, it could be the strike price times the number of contracts times 100 shares in one contract. The market price could be the price that shares are trading at today, and 3 contracts times 100, 4,875. When we subtract one from the other, we get the difference, which is the real value. If we were to sell the shares at the price that they are trading at today, which is 4,875, and we subtract that from what we would have paid for them if they were assigned to us, the difference, this 825, is the real value. The market value of this position is minus 1,207. The difference between this 825 and the actual option drag, which is the market value, is this 382. If this is the real value of the options, the rest, what would that be? The time value. Let's do the calculation here so that you can see that one minus the other gives us this one. This amount minus the real value is time value. Let's go through another example. The next one that we've chosen is BP for the same reason, because we're holding a put on this position and we also have the shares of this position. The figures that we need to look at to do the calculations are the strike, in this case 23, the number of contracts that we have sold 20, and market value, which is the option drag. The option drag for this position is minus 15,805. Here on the right hand side we have that the price of BP at the moment is 15 1548. Now let's go to the table as before and let's summarize the figures that we've picked from these two tables. The strike of the put is 23 and we have sold 20 contracts. If we multiply one by the other times 100 shares per contract, we get the price that we would have to pay if the shares were assigned to us. 23 times 20 times 100 is 46,000. If we were to sell those shares at the market price today, which is 1548, we would get 1548 times 20 times 100, which is 30,960. And the difference, one minus the other, would be minus 15,000. The market value, the option drag, is a bit higher, is more negative than the 15,040, and the difference between them is the time value. We'll do the calculations here on the right hand side again to make it even clearer. If the puts were assigned to us, we would be paying the strike of the put, which is 23, times the number of contracts times 100 shares per contract, 46,000. If the shares were to be sold to the market at the price that they are trading at today, which is 1548, we would be getting this price times 20, number of contracts, times 100. The difference between one and the other is $15,040. The market value is more negative, and the difference between both is the time value, because this difference here is the real value. Let's do the calculation under here. Market value minus the real value gives us the time value. This tab that we have here, that's called positions, includes two blocks with data. The one on the left applies to options. The one on the right has to do with the shares. Let's start with the options. Let's go one column at a time, explaining what information there is in each one of the columns. The first column is called symbol, and here we have the description of the options. For instance, this one is a put, because here under the column called put, it says that it's a put, plus there is a P here. BAC is the ticker, 2020 is the year of expiration, the next two digits, the 12, relates to the month of the expiration, which is the 12th month, December. 18 is the day of expiration, the third Friday of December. The P stands for put, and then we have 26, which is the strike price. We can see here on the next column, the one that's called expiry, that the date, well, obviously coincides with the information that the symbol has. Strike 26, it's also shown in this separate column that's called strike. The P that we saw here, it's also shown on a different column called call or put. Where it says description, we can see the name of the company, the underlying of the put. In this case that we're talking about, BAC is Bank of America. The account type could be general margin or cash secure. In this case is general margin. Quantity relates to the number of contracts that we have sold or bought. If the numbers here are positive, that means that we have bought them. In this case, the number is negative, meaning that we sold to open this position. The price is the price of the option as of today, and when we multiply the quantity times the price per share times 100, we get the market value, and the market value is negative. This relates, the market value is this negative number, which is the option drag. Day changes, what's the difference between today and the day before, and the underlying symbol is the ticker of the company that this option relates to. On the right hand side, we have the information of the stocks that we own at the moment. The first column is the description, again is the name of the company. The underlying symbol is here on the right hand side, that's what we call ticker. Account type again could be general margin or cash secure. Quantity is the number of shares. In this case, for instance, for this company, AL is 1,000. The price is the price at which the shares are trading at this moment that this snapshot was taken. A market value is obtained by multiplying the quantity, the number of shares that we have, by the price that they are trading at in the market at this moment. Day change is the difference between the market value yesterday and the market value today.